Focus. Ideate. Innovate. Enable.
Hello and welcome to another episode of NSE Fin Wiz, powered by CNBC TV 18 Season 3. Today we're in Delhi at the corporate office of the first company to produce auto-grade steel in India, Bhushan Steel. One of the prominent players in the Indian steel industry, Bhushan Steel Limited, has grown to become India's leading steel producing company. NSE FinWiz visited the office of Bhushan Steel in Delhi with the country's finest experts to advise and educate the young employees on investments and financial planning. Well, we're now joined by our two very special experts. We have Pankaj Mathpal, who's a certified financial planner and the MD at Optima Money Managers. Welcome to the show, Pankaj. And we have Ankur Kapur, who's the investment director at Ankur Kapur Advisory. Welcome to the show, Ankur. And our core topic for today is gold. Ankur, when we talk about gold, Indians, we love that yellow metal. I mean, that and real estate, two of our fondest things in the world. But how much should a person have of gold in their portfolio? What's your advice on that?
Well, firstly, you should focus on gold linked with some objective. For example, if you have a long-term objective or a medium-term objective of saving for your child's marriage or something like that, then it makes a lot of sense to accumulate that gold gradually. And other than that, just from an investment perspective, if you're thinking of saving in gold, then you should not exceed beyond 10% as part of the overall portfolio.
Okay, so a rough idea is about
around 10%, less than 10.
Pankaj, when we talk about gold, besides physical gold, nowadays for the last couple of years, e-gold, electronic gold has come into play. Just your thoughts on that. Is that a good option? Or because, generally as people, as humans, we love to touch and feel. So I would love to hold that 10-gram gold coin as opposed to hold a paper that says I have 10 grams of gold in a demat form. How do you approach this? Is e-gold a good idea, or is it better to have that 10-gram coin?
So there are two things. One is that if you want consumption, if you want jewelry, then definitely you'll buy physical gold only. But when it comes to investment, then paper gold or e-gold, what you're referring to, is better option. And because when you buy physical gold, you have to be sure about the purity of that gold. You're not sure whether you're buying from jeweler, it is really as what he says. But when you buy paper gold, there's a guarantee of purity. Second thing, also storing. When you buy a physical gold, you have to be careful. You usually keep in the locker, you pay locker charges. But when you buy paper gold, it is safe to hold. So considering those points, it is better to have paper gold compared to physical gold.
Okay. Ankur, recently in the news there was talk about the government's scheme. So there's this the gold bond scheme, the gold monetization scheme. How could you shed some light on that? And for our audience here who are maybe layman investors, new investors, they're at the beginning of their careers, are those good options for them to invest in?
Well, gold monetization scheme is a good option for those people who already have gold.
Okay.
Basically, you give that gold to the bank, and bank basically gives you interest, and that interest has tax benefits. So this is pretty much what the gold monetization scheme, primarily not from an investment point of view, but from other point of view that you can earn interest on gold.
But so how does it work? So because very often, so as Indians, we have a lot of jewelry at home, which again, you have sets will be used once in a year for a marriage or something like that. Under that scheme, can I submit a necklace or a gold set, or does it have to just be coins and stuff like that?
Well, you can give your sets or whatever form of gold you have. The thing which you have to bear in mind, first there is a purity test. And after that, your gold is actually melted. So you will not get your jewelry back basically.
Okay. So that has to be taken.
So there is a making charge and everything. That's a cost associated with that.
Okay, that's important to speak about. Pankaj, this question is from Neha Agarwal, and she wants to know a little bit more about gold ETFs. So what are gold ETFs, and how can we invest in it? Are they good to be invested in?
Good question. See, gold ETF is exchange traded fund. Any ETF is exchange traded fund, and when we say gold ETF, it is gold exchange traded fund. is kind of mutual fund only, and you have to buy it in demat form. 1 unit of e-gold, 1 unit of gold ETF is equivalent to 1 gram of pure gold, 99.5% purity of that gold. So basically the price will be similar to the gold price in India. You hold these units, you can buy as many as units you want, and you hold it in the demat form. Whenever you want to sell, at that, because when you buy at that time it is NAV based. So number of units you bought multiplied by NAV of the day when you buy, that is your cost. When you sell, that time number of units multiplied by NAV of that particular day.
Ankur, this question is from Nupur Jain, and she says, how is gold investment better than other investments?
Well, who says that gold investment is better than others? So as I said, gold investment should be linked with what is your objective. So whether it's gold or any other asset class, you should really understand what's your objective. And for the last couple of years, I don't think so. A lot of people have a lot of faith in gold investing as such. So because it has gone down, it has not delivered a lot of good return. But yes, Indians have this preference for physical gold as well as physical real estate. They can touch and feel, that is there, but it's just an asset class. It has its own cycle, it will deliver, it will decline, it works like that. So it is just any other asset class.
On that note, it's time for a very short break. Don't go anywhere, we'll be right back. Welcome back. You're watching NSE FinWiz, powered by CNBC TV 18 Season 3. Pankaj, we've spoken about gold. Like I said, lovely. Indians love the gold. The second thing that we love is real estate. And we're in Delhi. We've seen the Gurgaon just boom like crazy. Real estate's been booming here, and Mumbai, and generally the full country. Your thoughts on real estate when people come up and ask about, should I buy a house or should I just rent a house? I mean, I'm talking about that first home. What's your thought on that?
First house, I prefer people should own one house at least, because that gives you a feeling of security. So that is one point. And second, definitely because in house, not only rent, what you save, but other benefit as well. Capital appreciation is another point. And second, also if you borrow money on that, you also get tax benefits. So combining together all the benefits, I feel that everybody should have at least one house.
Ankur, I've heard from people at times, people talk about in real estate that I've got my first home, I'm happy with that. I've got some spare cash, I want to buy a second home and buy that home on installments and put it on rent. So kind of with the hope that the rent income will offset the EMI, and of course I'm building an asset on the way. Is that a good idea? Is that a bad idea? Or are there any riders on that?
Well, real estate investing is little risky, not from an asset class perspective. It's just that it's a long-term asset. Right. So I normally recommend, if you want to mitigate the risk, yes, if a person is thinking from renting it, then they are looking for ready to move in property and not an under construction. So yes, that's mitigating one level of risk. And after that, you have to just think that rental yield is somewhere around 2%, and it's a good rental yield.
Right.
If you're borrowing it at 10% or 9.5%, whatever that rate is, so you're basically incurring cost with the expectation that capital would appreciate. But since it's a long-term asset, and in case you need money, then liquidity can become a problem there. So it's not that easy.
I belong to a non-financial background and I would like to create a portfolio. But what would be better for a person like me? Should it be more in equity or mutual fund? Because I may not have the time or the understanding to monitor it all the time. So what would be a safer and a better way of going about it?
First thing I'll tell you that mutual fund is not a separate asset class. It is a vehicle to invest in different asset classes. For example, you want to invest in equity. If you don't want to invest in direct equity, you have equity mutual fund schemes. If you want to invest in bonds, debenture, like debt instruments, you have debt mutual fund schemes. If you want to invest in gold, you have gold mutual funds. So first is that there is no difference between equity or mutual fund. You can invest in equity through equity mutual funds. Second thing, yes, I advise you to start with mutual fund schemes. Because once you said that you don't have knowledge of finance, so definitely you should not go directly in equity market. Through mutual fund, which are better managed through fund managers who manage those schemes, you will get better understanding and better returns you can expect from mutual funds. Second thing, which scheme, whether equity or debt, I will advise you to go for the balanced schemes. Either if you have sufficient money, you can have one scheme of equity mutual fund, one of debt mutual fund. Otherwise, there are hybrid scheme. Hybrid means the scheme which invests in equity as well as in debt. So there can be a balanced fund which invests usually 65% equity, 35% debt. There may be a MIP scheme, monthly income plan, which has very less exposure in equity, say 5% to 25%, and rest goes in debt. So if your time horizon is longer, say 3 years, 5 years, something like this, you can go with the balanced fund, which has higher exposure in equity. If you want to invest for 2 years or like 2-3 years, then MIP kind of hybrid scheme can be better choice.
You're watching NSE FinWiz, powered by CNBC TV 18 Season 3. It's time for a short break. Don't go anywhere. We'll be right back. Welcome back. You're watching NSE FinWiz, powered by CNBC TV 18 Season 3. I have two very special guests with me, Pankaj Mathpal and Ankur Kapur. Ankur, when talking about mutual funds, there are a lot of mutual funds out there in the market. And obviously there is difference, so whether it's equity or debt or even gold-related mutual funds. How can one decide what's a good mutual fund? And, is there a benchmark, or what do you do to know that, okay, X fund is good and I should put my money in it or not?
So globally, if you see how to assess a fund manager's performance, you see the benchmark. But in India, hands down, all the fund managers beat the benchmark, which is the index, right? So that that benchmarking thing is taken care of. The next thing you should do is basically which are the top funds who have consistently performed over a number of years. Then there are other risk-adjusted factors and ratios to look into. Like Sharpe ratio, trainer ratio, which I personally feel a retail investor would not really have that much level of sense. But this kind of work is actually done if you Google it, and if you search online, you will get relevant material in order to understand, these ratios and how these work. But I would still suggest you can go with a long-term return, a consistent delivery of return done by a fund manager. But at times what happens is a fund manager has delivered well, but that fund manager has left the fund now. Then you need to just see that what is the track record of the fund manager who is running the show right now, just to make a complete sense of that performance.
When there are certain scenarios in the market that make an investor react very harshly, suppose recently after the China crash, there are speculations that in 2016 we are expecting a global recession as well. So how does one expect to, whether as a layman, should I keep my money invested because I'm not so well aware of the market? Should I move out of the market, or what should be my stand in that scenario?
Well, this is usually the case with most of the investors. And it's not just about retail investor, any investor. You have invested money, it's going down, you can see that, what to do with that. I think the only value add an advisor adds is on this kind of behavior, helping you just go through that in a very comfortable manner. Other than that, selection of funds and, even doing your plan, I think there are enough tools available, person can do that. But this behavioral thing, an advisor can help to just focus on the long term. If you're investing, let's say for a 15-year goal, and something is happening over a week or a month, that should not really impact your long-term goal or long-term strategic asset allocation or the way you have invested your funds. So that should not really impact, but you should just tell yourself always when the market tanks, it's not, you should not really get out of market. If you have invested into equity schemes or otherwise into equity, you should not immediately get out of it. So you should really tell yourself. And if the market is going up on the other side, you should not jump into it. So it has to be like always a gradual thing.
How does one decide on risk appetite while doing financial planning or making investment?
Pankaj?
See, a risk appetite, nobody knows better than you. There are two things. Sometimes people say, no, I don't want to take risk. Okay, because of their past experience, or sometimes because they don't have knowledge about the particular asset class. As Warren Buffett said, risk comes with not knowing what you're doing. So basically, suppose you say that I don't want to take risk, I don't want to invest in equity. I'll say it is, you are taking more risk, because if you are accumulating money for retirement and at the age of 60 you realize that you could not accumulate as desired, then what you could do. So basically, if your goal is long term and you know that equity is volatile in short term, but in long term that risk of volatility is minimized, then why shouldn't you invest? So it's not like that risk appetite is decided by some instrument or something. It is first thing you will decide because how many people are dependent, how much time is left. If a 60 years old person, he is not earning any more and he put his whole money in equity and equity market goes down, so he doesn't have a chance to recover it. But a young person who has much time left to achieve that goal, definitely he can take higher risk. He has more time to recover the loss as well. Second thing, in a longer duration, because risk of volatility comes down. So to answer your question, it is you will only decide that how much risk can you take. But yes, not taking any risk may create more risk in your portfolio.
Well, that's all the time that we have. So thank you so much, Pankaj, for being here. Thank you, Ankur, for being here. Thank you so much for having us here with you.
The show was very successful as far as even as a company exercise is concerned, and personally for me the topic of gold investments was something which I really liked, and I think it was very helpful hearing it directly from the experts who know exactly what are they talking about, rather than going as a layman going on internet and searching about it. So I think it was very helpful.
The show was really good. I would say very helpful for everyone out here. We were able to get a good understanding on the mutual funds, especially when how to select one, where to invest, even for a layman.
Well, that's all on this episode of NSE FinWiz, powered by CNBC TV 18 Season 3. But before we go, here's a chance for you to win a cool goodie bag by answering this viewer question.
What savings or investment vehicle should you use for funds required within 1 year? A. Stock market and equity mutual funds. B. Short-term debt mutual funds and liquid funds. C. Savings account. Send in your answers at fwq@network18online.com. The correct answer to last week's viewer question is option A, Sybil. Many thanks to all the viewers who sent in their replies. The winners to episode 12's viewer question are Nitin Patil and Vivek Fakde.
We'll see you next week with another set of young employees at another company. Until then, from the entire team, many thanks for watching.
Focus. Ideate. Innovate. Enable.